we think China looks to be the single best risk reward opportunity between now and year end in the globe. And gotten a lot of pushback on that. But again, we do the work here. We don't just talk, we do the work at TPW Advisory. And the work shows clearly that KWEB is outperforming the S&P and even outperforming the Qs.
Hello, everyone, and welcome back to Your Finance TV. Typical Friday, we've got Jay Pelosky with us. How are you, Jay?
Well, Scott, I'm pretty good, but it's not a typical Friday, buddy. It's Friday the 13th in October, and it's scary out there.
I know, this is very spooky out there. Markets haven't been that bad this week, but maybe a little spooky. And the title of your musings this week is Follow the Trail. Now, I know you're a big hiker. It's in your musings this week. I presume there's some sort of connection between the two?
Well, there is. I mean, you're a smart guy. You see see the connection. And yes, it is fall, right? Fall is a great time of year. It's football season, as we've discussed. Go Duke. It's the best weather in New York City. Fall and spring are my two favorite times of the year. And in the Northeast here in the United States, obviously, it's foliage season. So a lot of people out there on the trail doing some leaf peeping and whatnot. And it just struck me, since we've been talking a lot about signposts and how to follow what's going on through the transitions that we're moving through, that it kind of all pulled together by following the trail. And I had in mind my last trip up to the White Mountains in New Hampshire a year ago. And it's so beautiful that you're like admiring the foliage, and then you're like, whoa, where's the trail? And so, just a reminder to people amidst all the noise, and there's been even more noise over the last week, right? Amidst all the noise, it's really important as an investor to follow the trail, stick with the fundamentals, and not get swayed by a lot of noise, no matter where it really comes from. So that's the idea.
Okay, now, listen, it was obviously shocking scenes from last weekend in Israel and Gaza, and like all the events that have unfolded over this week. Hopefully we don't see it again this weekend, but you touch on that in your note. And also you dig a little bit further into the geopolitical front as well. You want to dig into that for the viewers for us?
Yeah, no, I think that's right. I mean, obviously, what happened in Israel last weekend was just a horrible situation, and as you say, it seems as if Israel's determined to attack into Gaza, and that's going to create just even more terrible scenes. I mean, obviously, you're talking about an urban environment, so certainly, hopefully, cooler heads will prevail. And as the market has suggested, unless the conflict really widens out to include Iran and Iran's oil export capacity, I don't really see this as a market mover. And so, importantly, when and the headlines are filled with all this negative geopolitical stuff, and you have guys like Jamie Dimon and Paul Tudor Jones talking about like the worst geopolitical environment in their careers, it's important to note that probably the single biggest geopolitical relationship and the most important is the one between the U.S. and China. And there, the news is actually getting better, right? We had a bipartisan group of senators in China last week. They met with President Xi, which is not the norm. They met with the top China leadership. And it increasingly looks like President Xi is going to travel to the United States next month for the Asia-Pacific Economic Cooperation meeting, which is going to be held in San Francisco. And he and President Biden are going to meet on the sidelines of that meeting. So to me, the number one geopolitical focus is U.S.-China, President Xi traveling to the United States, meeting with President Biden is an unalloyed positive for global stability. And then look, when you look at risk assets, it's the same thing, right? Sentiment has clearly cratered One of the technical guys we like to listen to is John Kovalos of MRA Advisors. He talks about capitulation in the rate sensitive areas, percentage of oversold stocks in the US market, climatic levels. So things on that front. And then as we talked about seasonality, obviously we're shifting from the worst seasonal period to the best. So risk asset wise, things are much better than one would think just reading the headlines. And then finally on the economy, it's the same thing. So again, we all this week is CPI and rates, etc. But on the side was the little U.S. economic data adjustment, which basically suggests that U.S. households have still, 3 years after COVID, $1 trillion or more in excess savings. And so that led to firms like JP Morgan raising their estimate for third quarter GDP from 0.5% annualized to 3.5%. So again, your CPI was off by 1/10, and things are really not good, as opposed to the consumer who drives the U.S. economy. We're 70% consumption. U.S. consumer has $1 trillion in excess savings that is going to continue to fuel consumption well into 2024, leading people like JP Morgan and others to not only increase 2023, but feel much better about the outlook for 2024. And I think that's, so you want to be even-handed. You want to follow the trail. You want to not get distracted. You want to be even-handed in understanding kind of what's going on across the economy, across geopolitics, and across risk asset markets, particularly if you are a global macro kind of shop, as we are here at TPW Advisory.
Okay, you talk about closing out the year or going through the rest of 2023 and into 2024 then. You write about your 4 signposts that remain. And listen, we don't want to give away everything. People can go read your musings, but give us a couple of those signposts that they're looking at.
Yeah, well, again, that's, we really believe you have to have a process, right? And you have to have a path and if you want to navigate global multi-asset markets. And we've had 25 plus years of experience doing that. I actually did a podcast called My Worst Investment Ever earlier this week. And I was like, well, I got so many to choose from. Which one do you want? So a whole nother story. But yeah, we've been in the business and at the game a long time. And we believe in having signposts, particularly when you go through transitions. And we are transitioning from, inflation spike to disinflation, from Fed rate hikes of a very aggressive nature to emerging market rate cuts, et cetera, et cetera. So we want to have signposts. And the 4, very quickly, and we'll touch on 2, continued disinflation in the U.S. We're going to touch on that. Global manufacturing recovery as we shift from inventory destocking post-COVID to inventory restocking, which obviously drives production, to continued earnings, positive earnings outlook, and then to China policy gaining traction and supporting that economic recovery in China. So the 2 we want to touch on today, one is the disinflation, right, with the September CPI. And look, I get it. The whisper number was that it was going to be 0.1% or flat, 0 month on month, and it came in 0.3 or 0.4. Numbers, I get a little confused sometimes. But, bottom line to us anyway, is that the disinflationary trend in the U.S. is very much intact. Just looking at my notes here so I get these numbers right. Core inflation continues to decline on a year-over-year basis at about 3%, the lowest since September of 2021, so the lowest in 2 years. Quarter over quarter, it's in Q3, core inflation ran at a 3.2% rate. In Q1 of this year, it was 5.2%. So the direction of travel is extremely clear. It's down. Now, it's not linear, right? You're going to have occasional little hiccups, again, in a transition. That's kind of to be expected. 1 foot forward, 2 steps backward, and we make progress. So to us, the progress is undeniable. The direction is clear. Gasoline and shelter were two of the big issues. Gas prices at the pump in October have been going down day after day, so that's not going to be an issue, at least in the very near term. And then shelter, we continue to think that shelter is going to become less and less of an issue. And I note in the musings that the San Francisco Fed just came out saying they expect shelter inflation will turn significantly negative by the summer of 2024. So to us, we're on track for disinflation in the US and Europe. Okay, earnings. Obviously, we're in earnings season. Banks started this morning, pretty decent numbers. And so, given that the Q3 GDP in the US is running at about 3.5% annualized, we expect pretty decent earnings numbers this quarter, and we think that supports the market. More importantly, though, is going forward, right? So we look at FactSet, and lo and behold, FactSet consensus is for earnings to grow about 8% in Q4 year over year and 12% in 2024. And if you get double-digit earnings growth, then you're not going to have big declines in stocks. And you don't need multiple expansion for stocks to rise. What we've had this year is multiple expansion so far, right? It's not been earnings driven. Going forward, the market is again transitioning from a multiple expansion, which is tough to do, particularly now that rates have repriced, to earnings driven, performance. And so if we're going to have double-digit earnings growth next year, then I don't see a lot of reason why we should be negative on stocks. And by the way, the rest of the world has both the earnings growth and the valuation, right? Pretty much every region, we had some great charts in the monthly on this last week. Every region is trading at a massive discount to history and a massive discount to the United States. And that's why we continue to focus a lot of our attention on the equity side to the non-US markets.
Okay, well, taking all of that in, and once again, you sound pretty bullish. So you've updated your model portfolios this week, as you do. Is there anything you should be highlighting to the viewers?
Well, we do, again, going back to the point of process, we have a very well-developed process that we've been utilizing for years here at TPW Advisory. We write every week our Friday musings. We hop on with YourFinanceTV to do the video, which is always fun and exciting. And then the next week we write the monthly, or the last week of every month, we write the monthly. So that was last week. That gets all our thoughts organized. Remember, the monthly 6,000, 5,000 words, 20 to 25 charts and tables from anywhere from 15 to 20 different research sources. So put all that together, and then this week we do our model portfolio updates, right? Our global multi-asset, and then our TPW 20 thematic model. And so this week, we do all that. We go through the technicals on all our positions, all the benchmarks, all the positions we're thinking of adding. Remember, we're ETF focused, 100% US listed ETFs. And what struck us were a couple of real interesting points, and I'll make them quickly. First is that nothing came close to the October 2022 lows. Remember all the bears talking about how we have to go back and test that level or break that level and go lower. Nothing in this correction in August and September came even close. And to put a bow on that, ACWI, which is global equities, is still 15% above the October 22 low. Now, many positions did retrace back to the March 2023 SVB banking crisis low and bounced off it very, very nicely. Here, the interesting point was that XLF, the financials ETF, didn't even get back to that low, suggesting that the market feels comfortable with the banks at current levels. The other interesting point, and this really drills down into like one of our main calls at the moment, is that clearly the U.S. is a leader, and tech is leading the U.S. best, by far, best looking sector technically. What's really interesting is that China tech, KWeb, is outperforming U.S. tech over the last 1 and 3 months. And that to me is really like the interesting thing, because there's been nothing but negativity surrounding China for months and months. It's like bash China season. And we've stuck our neck out and said we think China looks to be the single best risk reward opportunity between now and year end in the globe. And gotten a lot of pushback on that. But again, we do the work here. We don't just talk, we do the work at TPW Advisory. And the work shows clearly that KWeb is outperforming the S&P and even outperforming the Qs. So we didn't do much with our model portfolio when we updated it. We feel pretty comfortable with how we're allocated. We continue to be overweight equities, deeply underweight bonds. We have not had any U.S. Treasury exposure for 2 years. And while we got a little bit interested at 4.9 on the 10-year, boom, quickly back to 4.5, 4.6. So these levels not really particularly interesting to us. We think the better opportunity is if rates rally, then stocks are going to do better, right? So we'll take the upside on the stocks, not on the bonds. And then we remain overweight commodities, particularly energy and industrial metals. And so what we did was pretty basic. We added more to KWeb. We added to U.S. tech, those leadership sectors, and we added to uranium, which was the single best performer in both models. We think the uranium bull market is just getting started. And so those were the major changes, basically playing to strength, continuing to, put our money where our mouth is in terms of our China call. And at this point, we're quite overweight Chinese equity.
Well, Jay, listen, thank you so much for this rundown. I remember the chart from the uranium on last week's show, so all the viewers should go back and have a look at that as well. Jay, you have a fantastic weekend, even though it looks like it might be a little bit wet and chilly here in the Northeast. And we look forward to talking to you again next week.
All right, Scott. You too, buddy. By the way, I love that pink shirt. You wear that very well.
Thanks very much, Jay. For everyone else out there, good luck investing.